Welcome back to Successful Living. Interest rate environment for mortgage has been quite favorable, and to join us today via Zoom is Steve Tetzner, who is our mortgage expert. Welcome, Steve.
Thank you, Rob.
Great to see you. So hopefully we get you back in here soon. I know the quality is pretty good, but it's always better to have you here and to be able to have a conversation, but we're glad you could join us.
My pleasure.
So, Steve, if you can kind of start out, tell us, I mean, I've only heard good stuff, and you and I have talked off here about this, that, obviously interest rates are, feels like all-time lows to me, but what are the rates that are out there?
So the rates that we're currently seeing on our end, 30-year money, and this is all assuming good credit. The 30-year money is around 2.625, 20 years around 2.5, and 15-year seeing as low as 2.25 right now. The consumers are going to have to do their due diligence and do a little shopping around because not all lenders are offering these very low aggressive rates right at this time.
Okay. Do you see a lot, like right now in the refinance, years ago or what? I know every time I go, it's like, what are the points? Do you feel like the points are no longer there, or are they? It all depends on where you go. That people need to be aware not only of what the rate is, but what the points and closing costs are.
Right. So you should never pay points on a mortgage. That's about the worst investment you can make. When you're paying points on the mortgage, you are prepaying the interest on the loan. You don't prepay interest on any loan. If you have extra money, you put it towards principal and you borrow less. Closing costs are also, you have to be cognizant of what the fees are that you're paying in association with the loan. That's very important. There are programs that we are offering where there are no closing costs. We give what's called a lender credit, which is almost like reverse points, where we give a credit to the buyer to cover legal fees, title insurance, appraisal if needed, etc. So basically all they're doing is reducing their existing principal balance, refinancing their existing principal balance at a lower interest rate, not adding anything to the principal and rolling any closing costs in. So they're not financing closing costs over the next 15, 20, or 30 years.
Okay, and then would you say, if the client or the borrower has money available, that the smart thing, do you usually say, hey, if you have the money to do that, would you prefer that they do that to make the loan as small as they can?
Yeah, it depends on what somebody's looking to accomplish. If their goal is to pay the loan off and they're refinancing to a shorter term to be aggressive, then yeah, you want to borrow as little as possible because you'll pay the loan off that much faster and save that much more in interest. So anytime you can prepay a little principal or not have to roll in a fee, and reduce your rate and hopefully reduce your term, that's the best advice I can give everybody is don't be fooled by the scam of, you're 5 years into a 30-year mortgage and the mortgage company tells you, well, we're saving you $400 a month, but they're bringing you back out to 30 years again, and you're adding another 5 years worth of interest onto the end of the loan.
Yeah.
You're not saving $400 a month.
Right.
You really should always try to not extend the term of whatever you have remaining on your existing loan when you're refinancing.
Yeah, I think that's obviously great advice right there. So when, right now, lots, for instance, I know many people who have refinanced like twice in the last 2 years, and without being in it all the time, I'd be like, wow, that seems like a lot, and you pay extra fees or something. And I think a lot of people think about that, but what would you tell our listeners that if they are potential borrowers or people that are going to refinance, when should they consider refinancing right now?
Well, everybody should consider it right now if you haven't already done it. Whether or not you should do it, you need to run an effective analysis. Again, don't get caught in the extending the loan back out to a longer term and think that you're actually saving that money per month. You may be saving it in your monthly budget and your cash flow, but you're not necessarily saving that in interest savings on the loan. But run an effective analysis. Make sure you're working with a loan officer that can actually run that for you and make sure that they're telling you and giving you, the best sound financial advice. Everybody does have different, motives too for refinancing, Rob. Some people are actually taking cash out right now because the rates are low, so they're tapping equity because they're going to put on an addition or do a new kitchen or, finance some type of improvement to their property.
When they when they do that, does that does that give them a higher rate if they're just taking cash out, or not necessarily as long as
it does?
It does.
Yeah. So typically when you're doing a cash out refinance as opposed to just a rate and term and just refinancing your existing loan, you're looking at on average probably at a 1/4% higher interest rate.
Okay.
But if someone's going to tap $50,000 or $60,000 to do renovations, and they're locking in at 2.3 on a 15-year instead of 2.1 or 2.2, then how else are they going to get the money? If they have to go and get the money in some type of home equity product, then it's going to be at a much higher rate, and it could be a variable rate. So it might be better to just put it into the loan.
Got it. So what would be some guidelines that you would say, hey, this is what, I know you said everyone should be considering refinancing, but let's say we've got someone that's out there listening. Like, I've had clients call me and say, Rob, should I refinance? Should I be doing this? And what are kind of like, how much less should the percentage be? Are there kind of some guidelines that you would say, hey, if it's a point less, do it. If it's a half a point less, do it. If, what is that? Is there a number there?
No, there really isn't, because it depends on the size of your loan.
Okay.
If you have a $90,000 mortgage versus somebody that has a $490,000 mortgage, if the person with the $490,000 mortgage, if they're saving 0.75% on $490,000, they're going to earn back their closing costs, even if they pay them themselves very quickly. Somebody with a $90,000 mortgage, it's going to take them, for them to drop only 0.75%, it probably wouldn't make sense. So everybody's circumstance is different. You have to analyze the circumstance, what type of mortgage program is available, what the rate would be, what the fees are, kind of like, what we've already prefaced. So there is no general rule that just says, oh, if you're dropping the rate 1%, do it.
Okay. Okay, so does everyone, like I look at a rate and maybe the rate says, 2.9%. Does that rate apply to me no matter what, or do I have to fit some sort of description and it could go up or down? So for instance, someone advertises a certain rate, is that the rate I'm going to get definitely, or what affects that?
You have to look at the disclaimers and what assumptions they're making on the rate. So there are a number of factors that affect what interest rate an individual will get. So one person may not qualify for the same rate as the next person that comes in. So the amount of equity that you have in the house, the more equity you have, the less risk the loan is, the better the rate you'll get. Your credit rating is probably the biggest factor, your middle FICO score. So FICO weighs very heavily on what interest rate you're going to be able to get on the loan. As well, the type of property. We also talked about the type of transaction, whether it's a cash out or a rate and term or a purchase. But then also the type of property. Is it a single family, a condominium, a multifamily? That also affects rate. And then finally, what also affects rate is occupancy. Is it your primary residence, or is it an investment or rental property that you don't live in? So the more layers of risk, what happened back in 2008 when Fannie and Freddie kind of collapsed, is they developed what they called loan level pricing adjustments, which is basically just risk adjustments. Mm-hmm. So the more risk that they feel your loan has, the higher the rate that they're going to offer you for the standard agency programs.
Okay. This was something, and you and I had a conversation the other day, and I was, in preparation for this, and traditionally, before I knew more about the industry, I always, you hear there's banks, mortgage lenders, and brokers, and I always was thinking banks versus brokers, and the broker's going to charge me more money, so I should be going to Citizens Bank. I should be going to, the large banks out there because I'm going to get a better rate, and the broker's making more money. Can you kind of tell us the difference between those three parties, what you are, and that, that really is a myth in my mind, or it's just not even true? So.
Correct. So you have a mortgage broker, and everybody uses that term, and they call everybody a mortgage broker. That's incorrect. A mortgage broker is somebody that's not actually in control of the entire transaction. All they are is an intermediary. They're putting together a borrower with a bank or a lender. They're acting as a middleman, and then they're taking a fee for service. A mortgage lender is what we are. We are an actual lender. So when someone comes to us for the loan, we have complete control over the transaction. We order the appraisal. We process the loan. We secure a rate. We are able to, control the transaction. And then they're actually borrowing our money for a short period of time until we sell that loan into the secondary market. So we function the same as if you go to a bank, a credit union, or a larger mortgage lender. It basically the same scenario. When somebody's getting a conventional mortgage, a loan up to $510,000, I don't care where you're walking into, whether it's Citizens Bank or Navigant Credit Union or Homestar Mortgage, we're all getting our money from Fannie Mae and Freddie Mac. The only
Okay.
difference is we all work on different margins.
So Citizens is
And
not
then
lending me my money if I had a loan through them.
not if the loan is up to 510,000.
Wow.
They're getting that money from Fannie Mae and Freddie Mac just like we do.
Okay.
They will probably retain the servicing, so they'll act as the servicer for Fannie Mae, and you'll continue to deal with them and make your payments to them. But then they're going to turn around and make those monthly payments back up to Fannie Mae or Freddie Mac.
So I can get
What
the
we
same
do is
rates from you that I would actually possibly get from a bank? Is that what you're saying?
No, our rates are far lower.
Okay.
We've been doing rate surveys with the local credit unions and banks. And as I said, a lot of banks and credit unions and even lenders are not being as aggressive in their rates right now because there's too much loan volume. They can't process the amount of transactions with these low interest rates. So what they're doing to slow the volume down is they've raised their interest rates very high. We've seen that our rates are as much as 0.5% below what the local banks and credit unions are offering.
Wow.
So
Okay.
when I'm out there quoting you at 2.6, that's my rate. I quoted that rate out and shopped it out at some local banks yesterday, and they were all over 3% on the same transaction.
Wow. Okay, just to kind of finish up here, we have kind of just under a minute to go, but if someone engages in calling someone like yourself, what can they expect that process to look like? Has it changed at all right now? I mean, it doesn't seem like it would during COVID, but has it changed?
Yeah, it has drastically. And if you're currently on furlough because of COVID, or if you're self-employed and your business is negatively being impacted by COVID, then you could actually find it difficult to be able to refinance right now. So the process is a little bit more cumbersome. The documentation, because of the ability for people to not pay their mortgage, the forbearance program that the government instituted. If you're in a government forbearance program, you're not eligible to refinance your mortgage. So there are some restrictions, but for the most part, I would say 90 to 95% of the people that are contacting me, I am able to help.
Awesome. Steve, thank you very much. As always, extremely insightful. I enjoy our conversations, very knowledgeable, and we look forward to seeing you soon. So thank you.
All right. Thanks, Rob. See ya.
All right.
Be
Stay with
safe.
us. We'll be right back.